So one thing, let's move on from conventional loans and let's talk about government loans. And when we're talking about government loans, we're talking about FHA, USDA, VA. We deal with a ton of USDA in this area. So USDA is a rural development loan program. It's a 0% down program. And basically most properties outside of the Springfield area, Nixa, Ozark, most rural areas qualify for USDA. So let's talk a little bit about USDA and how it differs from conventional.
Well, it's interesting on a USDA, just a little trivia. USDA is really a conventional loan.
Interesting. Underwriting
wise.
Really?
It leans more toward the conventional guidelines than it does the FHA guidelines.
So guidelines as far as like income or property?
Property or just general both.
Okay.
It leans more toward, but like on the 90-day flip rule, we don't have that on the USDA.
That's true, right, yeah.
So where we have less of that on the conventional loan. And don't think there's not a red flag out there. Because if there's multiple exchanges on a property, it's going to be red flag, and I've had them where I couldn't do them before.
Right.
Because they changed too many hands, huge red flag, and they won't do it. But that's
a rare deal,
It is very rare. But if it's just a quick 90-day flip where someone's fixed it up, got it back on the market, it's better to lean toward a USDA than an FHA,
right.
For sure. That's kind of nice, and the underwriting leans toward that too. One thing to have stable income for a USDA, we have to have a solid 12-month history of that particular job or related jobs that amount to that 12 months. But that's where we come in the details of making sure the income works right.
Not to get a little off topic here, but you talked about work history. Typically, how much work history does a person need for any of these loan programs? Is that different between?
No.
No.
It's very similar, every one of them. All the government loans come from basically the foundation of a conventional loan. The foundation of a conventional loan is a 2-year work history. But there's justifications for a 2-year work history. If you're a nurse and you just got a certificate, or if you're an engineer, you just got out of college. Most generally, if you just got out of college and you're going into your
field,
thank you, that you got your degree in, that's what I was looking for, we can move forward, and you just got hired, and we don't have to have that 2-year history. You can immediately come out of college, get a job in your field, and I can do the loan if I got a 30-day pay stub. But if you're a nurse too, if you only have a 1-year work history, you've just got your certificate, I could usually use that. So there's circumstances where we can make it work. But most generally, they need to have a solid 2-year work history in, not necessarily the field that they're working in, but we don't want gaps, We can't have a 3-month gap and justify the history.
Right, because there's no income there.
And there's other guidelines that we got to follow.
And some things that come into getting tricky, and we probably don't need to get into depth here, but overtime hours, commission-based salaries versus W-2, a lot of those type of jobs and requirements.
We could do a whole section.
Need definite explanation. Once again, if you're having communication with your loan officer, you don't have to worry about these. But it is important to know that you do need, in a lot of cases, 2-year work history, because when you're having conversations about real estate, and the way you make money in real estate is by having conversations in real estate, is you need to know what to talk about. Hey, you probably need some type of 2-year work history or something equivalent to it. You need to know that overtime hours can be a problem unless they are consistent. You need to know that commission jobs can be a problem unless there's enough commission history to prove good income. Going back to the government loan, USDA, so you're saying it's a conventional loan, similar to a conventional loan underwriting standards.
Right.
It's a 0% down loan.
It's a 0% down, but on government loans, all government loans have some kind of funding fee to guarantee the loan for that organization, basically for the USDA to help them if it forecloses or not. On a USDA loan, it's a 1% funding fee, but the nice thing about the funding fee, it's financed into the loan.
On USDA, right?
On USDA, it's financed into, and all your government loans is financed. So, but they're different ranges.
So typically, on a USDA loan, your loan amount's going to be higher than your purchase price, right?
It's going to be a hair higher.
Yep, about 1% higher.
It's going to be 1% higher. And they have the lowest, they have an admin fee. It's 0.35% of the loan amount. And a lot of people think it's mortgage insurance, but it's really an administrative fee that they get each year. It's accumulated in escrow, and then a check is sent to USDA at the end of the year, but it's a part of their escrow, and it's relatively low compared to FHA, honestly, and conventional loans.
So on USDA, essentially you're looking at, your admin fee, your funding fee, and then you still do get PMI, private mortgage insurance, right?
That's what I was talking about.
Is that the funding fee?
That's the confusion.
Okay.
No, the admin fee is the mortgage insurance.
Is it? Okay, so so there's no
people
additional.
Think it's a mortgage insurance, but it's not.
But the 0.35 you're saying is cheaper than PMI typically on FHA or conventional.
It is usually.
That's what makes USDA so popular around here,
Right,
especially
100% finance.
we have so much areas, most all of Christian County, I guess, would be USDA.
I tell everyone, it's Springfield, Battlefield, and Brookline. If you're outside of those areas, you're in pretty good shape. Fellows Lake North.
Yep.
Past it, you're in good shape.
And you can Google USDA eligibility, put in the address, and it shows you. So
it shows a big map, comes up, boom, boom.
Because part of Willard, there are Willard houses that don't qualify, and there's Springfield houses on that side that do qualify.
There's Stratford addresses that don't qualify.
Yeah, so
people think they're in Stratford, they qualify. There's a fine line there between Springfield and Stratford.
If you're going to
cause trouble before.
If you're going to be listing a property, check the eligibility before you check that it will sell USDA.
There's a few Battlefield addresses, but they're south of Battlefield a little bit that are still addresses but most Battlefield addresses don't.
There's you still have closing costs on the USDA, so that's the one conversation.
The seller concessions on closing costs can go up to 6%.
6% on USDA. What about income limits for USDA?
That depends on family size. I can't quote you the exact amount. It's like 103 for family size of 4, and it goes higher.
Yep, and didn't they recently change it? Or they're talking about increasing them, right?
Did.
Or they just increased them?
The 103 and whatever the other one is, I have to look. I can't remember.
But that's something to watch. And really, once again, that's not, you need to know there's an income limit there. But it's the communication with the loan officer that's going to tell you what program you're using. I know I'm like a broken record, and I do that in a lot of my training, but the key is communication. But there is income limits, so if you make too much money, you might not qualify for USDA, and it is based on family size.
We've got people into loans, and we think it does, but they're working more hours than they projected.
Oh, and so the overtime can throw them off, and some
absolutely.
of the
because it's a projected income too. And you got to that's where the income comes in. If I tell you you're going to get a USDA, I want to be able to make sure. And I may go to the point of getting the verification of employment to make sure my income is in that category. I do keep a cheat sheet on my desk, so if I need to know that number, I can get it, but I can't pull it.
And two, I believe Gershman does have the handy home buyer guide that talks about all the different loan programs. It's kind of a quick sheet. We keep these in the office. I also have a PDF of them. If you want to see them, they keep them updated.
I need to update it, probably. I need to go back to
I think the new PDF one that you just sent me is pretty updated. But we do have this. This is a great tool. I reference it still. It talks about the percentage of closing costs that we have, and it's kind of a quick sheet about what we're discussing here overall.
Right.
Another thing on USDA, you've got the income limits. What about, it is a primary residence loan. Basically everything we're talking about is a primary residence loan for the most part.
So if we get into the appraisal side of it, which is the next important piece for you guys, is that they follow FHA guidelines. They follow HUD guidelines.
On the appraisal side.
So that's where it confuses me. Sometimes people think they could, we're not going to do FHA, but we're going to do a USDA. Well, you have to deal with the appraisal because it's an FHA appraiser. An FHA approved appraiser is a qualified USDA appraiser.
Okay.
It's that simple. So we're following where else we lean toward conventional guidelines, and they're conventional USDA own guidelines on the underwriting side of it, but the appraisal is going to be an FHA appraisal, basically.
And so talking about appraisal and FHA appraisal, the way I usually describe it is that, in the appraisal process, it is a tighter appraisal. It's not a home inspection, but they do look closer at defects in the property. Well, and I've seen anything and everything, and it's so much up. I mean, there's a book with guidelines. They're big on like peeling paint. They don't like peeling paint. Health and safety measures is what falls into it. Railings being a code standard, decks not falling off, bad roofs. I mean, probably the biggest thing I've had flagged in predication work is what they call it in the government loan writer is roofs. I've had peeling paint, mold. If there's mold mildew that then the appraiser finds, that almost gets flagged. GFIs get flagged. There is some standards that go into the FHA and USDA appraisal process, and VA. VA falls into that too, right?
So when you're thinking about government loans, you want to look at the house in a perspective of what is detrimental to the structure's life, is the way I put it.
That's a good way.
Yeah, anything that's detrimental to the structure's life, peeling paint around the windows, siding with holes in it,
termite,
siding's coming, termite, foundation issues, if there's a crack in that. But the big thing people get frustrated about, and I understand it, but the outbuildings.
Yeah.
The outbuildings, if you have a bad roof on the outbuilding, it has to be fixed. If it's peeling paint on the outbuilding, it has to be repaired. And that frustrates people, but they consider the outbuilding a part of the structure, the whole structure, and it has to be the same condition as the home. Mm-hmm. And so if you have an outbuilding out there that's pretty rough, we've literally removed them before.
Yeah.
Just to make it go through, because it was cheaper to remove it than fix it.
As you guys know, I'm huge about water around houses. So, if I buy a house, so in my mind, if you keep a good roof, keep the insects away, and you keep the water away from your foundation, your house will last for 200 years. And I've had it where an appraiser came in and there was a retaining wall that was keeping the water from hitting the foundation, and it was leaning, and they flagged it to be repaired before. It's not always just a house. It's about what could happen to the house too.
It could be the road too.
Yeah.
If the road is a hazard and it's rough and stuff, I've had appraisers ask for them to be, you can't get up that road and they want it graded or they want something. The other thing on guttering isn't necessarily required. If the property is built in such a fashion where the appraiser can note that the water is running away from the foundation, they're not going to ask for guttering. And he brings up a good point. I was thinking about this when I was trying to prepare for this before I even visited with him. Some things you may just want to wait till the appraiser points it out. You may not want to go in there and think that you're the expert and require your person. You want the cosmetics to look, you want it to look nice. You want it to be clean. You want it to be presentable. But don't go in there and say, hey, I know that's going to get flagged. It may not. That appraiser may be going so fast they don't even notice.
I've been there with them sometimes. It's a 3-minute deal. They walk in, they take pictures, and they're out. And I've been there where it's been an hour-and-a-half deal.
Right. And it depends on their timeline and where they're going. And, if it has 4 steps on it, there's a good chance they're going to call for a handrail. Mm-hmm. And if you got just an open deck and it's above 18.5 inches, they're probably going to want a rail on that.
Yep.
18.5 inches is the height that is considered that they want a new handrail. It's in the guidebook, 18.5 inches. Some of them measure it, some of them don't. They'll look at it and they go, oh, that's not 18.
This kind of goes a little bit back to, for my sellers, I always like a pre-inspection.
Right.
So, if you work, I use Vince Tantone with Urbane Fix an awful lot. Well, these railings it is method inspection. It's not your Urbane. He changed names. It's method inspection, but he's a good guy, and his wife's even a competitor agent too, and they got a brokerage, so you got to watch them a little bit. But
she's a good gal.
They are. They're great people.
Great people.
They're going to flag those railings because they're not code, and it can help you identify some of those issues before the appraiser comes into play.
Absolutely.
If you look, so if you're using MR forms now, our old forms used to give a dollar amount that a buyer was willing to pay for the predication work. Now the contract just says it's got to be negotiated between who pays for it within 35 days is the default on it. So, if I know I'm going up against an offer with a conventional, sometimes I'll write in special agreement that the buyer agrees to pay up to $500 in predication work if required. And I like to do that a lot if my buyers have the money, just because it puts them on that same level playing field as conventional. Because a lot of times sellers don't want to take the FHA or USDA, even if it's more than the conventional, because they're worried about predication or repairs required by the appraisal. So if you put something in the contract, my buyer's willing to pay $500 or up to $1,000 in predication work, it can help remove that stigma that the conventional loan's better than FHA loan. And it still kind of applies to me. Sometimes I like working with a USDA and FHA buyer when I have the seller more than a conventional, because they don't have the money. Now, they have to make it work, you know, like they're selling their house or they're moving out of a rental and they've got to be in this house, where the person that has $50,000 to put down on a property, they have flexibility not to make this transaction work, where sometimes that USDA and FHA buyer does.
Or they'll just back out.
Or they'll back out.
Inspection, they won't worry about trying to make it work, and they'll just go into the next house.
So, you know, I think that stigma that conventional and cash is always king over some of these government loan programs isn't giving them justice, and not, I mean, you got to look at the motivation on a buyer and what it'll take to get it to close. And a lot of times these FHA, now if it comes down to money and they don't have the money to play, it's nicer to have the conventional. But a lot of times they have to move. By the time they're 2 weeks into this deal, they're going to move one way or another, because otherwise they're going to be homeless.
Cosmetics aren't as big a thing anymore. They used to be really big on the government loans, and it's not so much. If it's move in, you know, the carpet's in decent shape, it's not down to the subfloor, most appraisers are going to let that slide.
Yep.
You know, we've done some pretty rough properties for government loans and gotten them through. But when you do a very rough property, you got to have everybody, the lender,
Everybody got to be working for it.
the buyer's agent, and the seller. Everybody has to do. I mean, I just did a really older home. We all worked together, and we got it through for FHA. And it was interesting because the buyer, she paid all the repairs. Going in, they said it was as is, but we will work with you. The agent had, this was around Cassville, the agent had a contractor that would do the repairs, and when they did the home inspection, there was quite a few things that she wanted repaired, the lady buying the house, and she talked to the contractor guy that was willing to do all the appraisal repairs, and he went ahead and fixed the little miscellaneous things that she wanted, and it was a win for her, so she doesn't have to do it later. She paid $3,700 for repairs, but they'd already put a new roof on it, and they had already done some other things to fix the guttering and the roofing and stuff, so it'd go FHA, and they couldn't go in.
They didn't have money.
They didn't have
no money.
There was no money, so the buyer was willing to pay those, and we wrote it in there. They all wrote the addendum in there and stuff. But as long as you make it plain in the addendum, it works. And we actually put that invoice on her side, and it was all part of her final closing fees.
And that, talking about repairs too, not just predication work. So a lot of times we'll run in, I mean, probably roofs is the most common, right?
Right.
So, you know,
most important.
That's most important, but they get flagged a lot, and, you know, they're an expensive item, and typically we need to have it done before closing, right? So if there's repairs of that nature, They're supposed to be done by closing. You know, we run into, so talking about repairs, if you have something like that, I think it's important to have, what's your recommendation? So if I have a deal where there's, you know, $3,000 worth of mold mitigation that has to be completed, buyer's not paying for it, the seller doesn't have the money without closing costs, how do you work those things? Can you keep stuff in escrow? It's gotten harder and harder to
on USDA,
to do.
You're going to have a problem with that. FHA, we have a program, but not on USDA. On a USDA, you're in trouble. You're going to have to figure out some way to pay for it. And a lot of times,
what about having the seller pay for it at closing?
They can.
Yep.
You can have the invoice. The main thing, as long as your work is done before and we get the final inspection, the invoice could be put there.
Now that's predication work though, but I'm talking about repair work. Something, you know, just an inspection repair, the appraiser didn't flag it, but, you know.
I have nothing to do with that.
Right.
That's I told you, I don't have anything to do
But we
with
can't keep money in escrow for these in most cases. Now conventional you can. Won't conventional allow you to put 50% back, or you got to hold, like some banks will let you hold 150% of the roof in escrow.
Well, if it's a roof, we can work around a roof.
Roofs can work.
But you're basically just repair stuff that you're looking for.
Yep.
But if it's a roof, most generally we can escrow for a roof.
Escrow for a roof.
A program for that. I don't think we can do it on a conventional loan. We could do it on an FHA and a VA loan, but I don't believe we can do it on USDA.
I've also worked in some before, and this is depending on title company and lender, where we pay the roofing invoice at closing, and the title company holds the check until the roof's complete. Now that's outside the loan officer, I think, in most cases. But
no, I've done some where we've gone ahead and done the escrow.
But if you get into these situations with bigger repairs or something we got to get creative with,
you have to get with your loan officer.
Or
Let us find out what we can do. We push back on underwriting.
And probably in this case, you should probably have a conversation with me first, and I'll point you in the right direction on how to happen. Don't just handle it yourself, and don't assume it can just be paid. Talk to me, make sure we've got it going good.
Yeah, you want to talk to that company that you're working with and see if they're underwriter or they're going to allow that.
And there's some vendors that work really well with us too, even on some crawl space repairs and stuff. So if you've got bigger repairs and we got to get creative, bottom line is talk to me about it and we'll figure it out.
I know Jamie says he'll always do that.
Yep.
With Garrison Roofing.
He does a good job with it. We do a lot with him. Buzz Pest Control does a lot of our vapor barriers and some of those type of stuff too. So USDA, anything else we need to talk about on USDA?
You know that seller concessions are your basic 6%. I think we discussed the appraisal more like an FHA appraisal. I think we're good.